Hello everyone, welcome to the second session, the basic sessions that we have started for financial reporting and analysis. Mm, in this session, we are going to build up on the fundamentals that you have seen in the first part, wherein we had started by things like what is a liability, what's an asset, and different aspects. So, building upon that, we are going to talk about certain important aspects, the basic definitions in it. So, I'm going to start with something called as accounts. What do you mean by accounts? I mean, that's what basically the name of the subject also. So it's very critical to understand what do you basically when do you call something as an account. Now honestly, just a quick point, if let's say you've done your accounting, let's say any program before, let's say a CPA or a chartered accountancy or an ACCA kind of a thing, or in your graduation or high school you've already done accounting, so this might look very basic to you. So my suggestion will be that you can directly jump a couple of these basic videos and directly look at some of the conceptual aspects of income statement, which is part of reading 25. So there the idea is that we are recording these from a point of view of people and students and candidates who are very new to accounts. Okay, so I call something as an account when it has records of something as in the historical transactions. Now it could be a personal account if it has got records of personal transactions, and it could be a financial account or a business account if it got record of certain business transactions. Now how do you maintain these accounts? Basically, accounts is a three-step procedure. One, you maintain a journal, also called as book of primary entry, general ledger, the book of secondary entry. So the pronunciation is similar, but the spelling and meaning is absolutely different. And third is the trial balance, which is really the mathematical accuracy, the checking part of it. So what happens really is, this journal is a book where the transaction as and when that happening are recorded without any classification. It's like a dump, which is a date wise dump. Okay, so the moment a particular transaction happens, you just record it bluntly, without any analysis thing put into it. So the advantage of that is that it is very comprehensive, and very important aspect, not only from an exam but otherwise also, that if anything gets missed at this stage, it gets missed really at the entire accounting. It will be very difficult to get hold of it, because this is really the base information upon which the entire journey is being built. So that's the reason why it's called also as a primary book of entry, again an exam aspect. So what really happens here is that you're creating a dump day wise, date wise, time wise, and by the end of the year you really have record of let's say 100,000 transactions. Now if I give you these 100,000 transactions, you will not be able to do much about it, because that ultimately, I mean, there is no categorization. So you really need to make this data a little more manageable. Okay, by manageable I basically mean a controllable data. I mean, this is too vast a data to do any kind of an analysis based on that. So the classification part of it is being done in something called as a general ledger. What is a ledger? Ledger is basically one particular nature of account. Okay, let me give you some example. Let's say sales is a ledger, purchase is a ledger, rent is a ledger, salary is a ledger, capital is a ledger, equity share is a ledger, preference share is a ledger. So all I'm trying to say is, let's say in this data dump, sales to A, sales to B, sales to C, all being recorded at respective days. But if let's say the business wants to know how much is the total sales that they've done, obviously they will maintain a page in the register with the heading called sales, and sales to A plus B plus C plus D, so on and so forth, is going to come and on that page. So if someone wants to really find out the total sales to over a period of time, you can just look at that total right away. So what it does is 100,000 transactions will be classified into 100 general ledger. Okay, and obviously there is a lot of mathematical aspects involved here, because from 365 pages, let's assume one page per day, from 365 pages you are almost like summarizing it into just 100 small categories. So a lot of mathematical aspect involved into it, just to ensure that there is no error or a mistake, you make some kind of a balance. I mean, balance, as we all understand, is got two parts. Just to ensure the weight is equal to what you want to. So that's exactly what we do. I mean, there is a plus on one side and there is a minus on the other. Now, those who have done accounting will understand what is a debit and what is a credit. I really don't want to get into it, although your CFA books goes into it, because from an analysis standpoint, your debit and credit are really redundant. I truly believe that from an exam standpoint, this debit credit is not very important as much as to understand the basis and genesis of accounts. Okay, there's something called as chart of accounts. This chart of account is basically the list of these 100 ledgers in which the entire data dump is being summarized. Okay, 99% times you will find that companies in the same industry will follow the same chart of accounts. See, every company will pay salary, every company will pay rent, every company will have capital, share capital, sales, purchase, so on and so forth. So what I'm trying to say is, it is not very innovative. But of course, let's say industry wise it might be a little different. Let's say oil and gas might have a particular ledger in which an industry specific, let's say, duty or a permission or a license or anything like that is kind of done. Coming to a definition of accounting, well, pretty simple. Accounting is the art of recording. Recording where? In a journal. Classifying where? In a general ledger. And trial balance, which is summarizing. So basically what you're doing is, accounting is the art of making accounts, as simple as that. And in terms of money, that means anything that I'm going to record has to be in dollar terms. So that brings me to again one of the points, that while at the time of writing definition of asset, we had said future probable economic benefit. The word economic signifies in terms of money. Okay, what do you record in accounting? Any transaction or event which are in part of financial character, and obviously we say that interpreting the result thereof. Although I truly believe that in accounting none of this aspect happens, because this is part of your financial statement analysis, not your preparation of the statement. Coming to another definition, very important, is accountancy. And how is it different than accounting? Again, a matter of examination. Now, if let's say there is a construction happening at my place, I mean, I'm getting, let's say, my room renovated. Now, there is a paint brush which the painter has got. Okay, he wants to do renovation, or let's say painting, using a tool called as paintbrush. This exactly is the difference between accounting and accountancy. Accountancy is the tool using which accounting is done. Okay, so process remains accounting, and the accounting is done with the help of something called as accountancy. What is accountancy? These are the set of principles, technique, rules which are used in accounting to bring, I want you to write the keyword here, standardization. Imagine if there are 100 accountants in the world and all 100 are doing accounting as per their whims and fancies, then the same business transaction happening on the ground will be reflected differently in different books of accounts. So if these books go to a particular investor, looking at these different books, investor will be able to draw conclusion that the business situation on ground is different for each one, whereas as a matter of fact that is not true. So therefore see, your accounts basically have to mirror the business reality. That's my genesis of making good accounts. Whatever is happening on the ground should be mirrored by my accounts. So if same thing is happening, then the business accounts should also mirror the same thing. That's my point, and therefore I need standardization for. Okay. Now, in every country there are two types of bodies. One is the technical bodies which make these rules, but they don't have any enforcement power. Okay, let's say FASB stands for Financial Accounting Standards Board, one of the bodies in US. Should I say only body in US which talks about making of the account, making of the rules. But point is, they don't have the enforcement power, for which they go to SEC. So SEC is really the big daddy, and these big daddies enforce the rules which are formed by their technical counterparts. So exam question: which of the body is responsible for enforcement? Answer is regulatory. Which of the body is responsible for creation of the rules? Answer is technical bodies. Okay, as a hygiene factor, you should understand and remember the full forms of it: International Accounting Standard Board, Financial Services Authority, Securities Exchange Commission, obviously, and Financial Accounting Standard Board. And obviously, the third best body is in India, which is formed by Institute of Chartered Accountants of India, and Securities Exchange Board of India is really the regulatory body in that sense. So coming back to something called as the basic definition, there is a basic difference between what is accounting and what is reporting. Now the difference could be understood contextually. If you look at right now, I am telling you something, so for me it's an outgoing, and you are receiving something, so for you it's an incoming. Okay, this is exactly the difference. Accounting is a matter of incoming, whereas reporting is a matter of outgoing. Okay, so this is like the way I used to understand as a student, and I'm sure that you'll kind of benefit from it. So this brings me to one of the slides of the previous topic, wherein I had said that accounting is really the incoming and reporting is really the outgoing. So that exactly is the point that I'm driving home right now also. Here what we are saying is that the outgoing has to happen in a standardized, absolutely standardized way, and that way is, let's say, one of the formats that is being referred here as a financial statement. What is a financial statement? Financial statement is a medical report about a company talking about a particular issue. Income statement, for example, talk about the performance of the company. Balance sheet talk about the position and change in position. Cash flow talk about liquidity aspect about the company. Okay, so on and so forth. So these are like the medical statement about the same individual called as company, talking about different aspect. Now just, I understand that this is pretty commonsensical, that if, let's say, you want to look at the bones of an individual, you got to talk about something called as an X-ray. In the X-ray, you will not be able to find anything related to the brain, because for brain you need to do another test. So there is a specialized report for each purpose. This is exactly the point here. If in income statement you really want to look at the assets and the liability, it will not make sense, because for that there is a specific report called as balance sheet. Okay. The fourth here, which is not so important but is gaining importance over a period of time, is something called a statement of change in owner's equity, as to how have their stake over a period of time changed. Okay, the fifth point written here is honestly not one of the financial statement. It is actually the explanation. I want you to write keywords here: estimate, assumption, and policies, which the accountant has used to make these four, are explained by him to the analyst under financial statement notes, as the name said, footnotes. This is a very, very critical and important aspect about a company, because before looking at the income statement, you should definitely, or let's say looking at the balance sheet, you should definitely look at the policies that he has followed. An example of that, if let's say he has followed straight line method, the other company have followed WDV, obviously the one who is following written down value will have a higher depreciation. It is not a matter of inefficiency, but it is a matter of accounting policy. So as an analyst, you should be very, very clear as to which accounting policies the company is following, and that info is given in financial statement analysis. Okay, the last point here has already been explained, is financial statement analysis, and that's where a CFA comes into picture. Okay, so we're going to talk about more in our next video. So I hope that the second session on the basics is clear. We have a couple more sessions on the basics, so those who are, like I said, new to this field, new to this discipline, new to this profession, should look at them. But those who are already aware about the basic accounts and all, can directly skip to the income statement videos. Okay, so talk to you soon. Thanks very much. This was Ankur from Finstudyclub.